It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. A win for chips. Nvidia expects to gain U.S. approval to sell a model of its AI semis to China. Fighting back, the EU finalizes another list of tariff countermeasures to target U.S. goods worth over $80 billion. And bank earnings kick off. JPMorgan, Citi, Wells Fargo, all on deck alongside CPI this morning. So we got the data, we got the earnings, and ahead of that, futures hit another all-time high. We're up 1/3% and 0.5% for the NASDAQ. The reason for this outperformance is Nvidia. Valerie Teitel will give you the details of that in just a moment. But in the meantime, for this bond market, we are a little move this morning after a sell-off yesterday to slight gains for your 10-year yield. Yields come down about 1.5 basis points, 4.4% is where we stand. And a little bit more weakness in crude. We're trading just below $69 a barrel, down 0.4%, a bigger decline yesterday off the back of Trump threatening secondary tariffs for those that trade with Russia and Russian minerals, that really affecting oil and will have a big impact should it go through. Let's get you that Nvidia mover along with some other stocks to watch. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. Yeah, NASDAQ futures trading at record highs. It's all down to Nvidia, up some 4.5% pre-market, as Nvidia has been given the green light from the Trump administration to sell its H20 chip into China. This is seen as a big win for CEO Jensen Huang, who's been a vocal critic of these export restrictions. He's currently in Beijing as we speak. Let's move on to some tariff-exposed stocks from the EU's retaliation measures, said to be focused on Boeing and Kentucky bourbon. We're seeing Boeing falling some 0.8% in pre-market trade. Brown-Forman is the owner of Jack Daniels. It was in the red, now trading unchanged this morning. And lastly, Danny, let's start on those banks that are kicking off earnings season today. JPMorgan, Wells Fargo, Citigroup, all reporting before the bell. The attention will be on their trading desk revenue. Have they captured from the volatility of the second quarter? Also, any color on their loan loss provisions, on how these banks are preparing for maybe an economic downturn in the later half of the year. Danny.
Valerie, thank you so much for that, and we'll catch up with you later in the hour. Also in this hour, we'll speak with Peter Oppenheimer of Goldman Sachs to go through an earnings preview, and we'll take a look at private markets with James Clarke of Blue Owl later in the show. We also discuss the latest trade headlines with France's European Affairs Minister, Benjamin Haddad. Now, stock futures, they are gaining, trading at another record. It's a busy day of earnings and of data. In a recent note, Goldman's chief global equity strategist, Peter Oppenheimer, writes, quote, while U.S. fundamentals remain solid, the valuation premium is increasingly difficult to justify for U.S. equities and the dollar, especially as non-U.S. markets begin to show signs of relative strength and investor flows broaden. I'm pleased to say that Peter joins us now. Peter, does that mean an expectation for a melt-up this summer that you don't share those same expectations?
Morning, Danny. Look, I think the U.S. market still looks solid. The fundamentals are good. Inflation's coming down and interest rates alongside that, and we don't expect a recession. That tends to be a relatively benign environment for equities. But of course, the U.S. market is still very concentrated, driven by these super large tech stocks, which are fundamentally very strong. But there's less breadth there. And what we are starting to see, especially with the dollar beginning to weaken, is a growing opportunity set to diversify into other markets where valuations are a lot cheaper and the fundamentals are also improving.
Peter, the latest fund manager survey out of Bank of America showed a huge reversal in risk sentiment. Risk appetite surged by the most ever in the past 3 months. What do you make of this market that still has plenty of headwinds, from it being uncertainty about the data and whether the Fed will cut, to trade headwinds, and at the same time continued buying and continued record highs?
Yeah, in some sense it's difficult to circle because, as you say, there are some obvious headwinds around. But I think that the markets have pulled back from really worrying about recession earlier this year and a very significant shock and impact from tariffs. Now, to some degree, the fears have moderated as tariff deadlines have been passed, have been extended, and some of the worst fears about the scale of those tariffs have been pulled back. And actually, the macro data has remained solid. And I think that combination, together with the prospects of still looser monetary policy and continued economic growth, is really what's supporting equities. And we should also recognize that the broader index levels are really obscuring some very important dynamics, which is that you're getting extremely strong power in certain parts of the market in the US, particularly large cap tech again, and in other markets, pockets of value which are recovering from a very low base. Things like European banks, for example, which are even outperforming large cap tech for the first time for a long time. And that's broadening the opportunity set. But not all companies are rising to the same degree. That's why diversification is so important.
So you mentioned some of the outperformers there, Peter. Where do you want to be positioned in this environment where diversification is more important?
Well, I think that we like to see broader geographical diversification than many investors have been used to, because the US market and the US dollar have been outperforming really for 15 years now, and that's left many investors with very concentrated positions there. We like Europe and parts of Europe, particularly value and the banks, also exposure to defense and infrastructure plays as you start to get more fiscal easing in Europe. Selectively across emerging markets as well, we think the environment is relatively benign now, with the dollar beginning to weaken and US rates coming down. Many of those markets are cheap. Korea and others, for example, we think have further progress to make. But you mentioned earlier in your report banks. We think banks are in a good position. Household and private sector balance sheets remain pretty healthy. Steeper yield curves are beneficial. And of course, if you continue to get economic growth, that tends to be a good environment for the bank sector as well.
So, Peter, do you understand what will be overall more important for this market to provide more fuel for the next leg higher? Is it just looking at this week alone? Is it CPI, something that confirms that the Fed will be able to start their cutting cycle, or is it strength from earnings?
Well, I think the earnings report is going to be vital. I mean, we do expect the CPI numbers to be slightly below the current consensus. I think that will help to cement confidence in a further progress towards rate cuts, particularly in the US. But actually, earnings are going to be pretty crucial. The expectations in the US for this quarter are relatively moderate, around 8% growth year over year. We think the market will be able to beat that. But I think the key is going to be in the detail. What's really happening to margins? Because margins have been holding up very well. Generally, companies have been able to be passing through higher costs and the effects of tariffs to consumers. But as the labour market weakens a bit, it's going to be really important to see whether that trend continues or whether companies are beginning to suffer from some margin squeeze. And I think that's an area of vulnerability, particularly for those companies that might start to see lower margins. So we're looking at companies with strong balance sheets, high and stable margins, both in the growth and the value space. And I think that's really the sweet spot in equities right now.
Peter, it has been really remarkable just in recent days to look at the likes of Amazon seeing the biggest ever Prime Day, to look at Delta saying that bookings for their flights are going to be improving in the second half of the year. Is this a story of consumer resilience, or is it a story of unevenness, the haves and the have-nots of some companies that are able to hold on to margins and others that will not be able to?
We're differentiating between the companies that are holding on to margins and those that aren't, I think, is a really interesting and important strategy to be following. But fundamentally, I think what we're seeing here is that the consumer generally is still holding up quite well. Broadly, in most countries, unemployment is low. Household balance sheets are pretty good, particularly outside of the US, but even in the US. And of course, there is a differential across the income distribution. But overall, that resilience, I think, is relatively healthy, particularly as we go into a period of lower interest rates. And we've long believed that we wouldn't see a recession in this cycle. But it is really important to emphasize, I think, that private sector balance sheets, households, but also importantly, corporates and banks are relatively strong compared to many other periods that we've seen. And that resilience, I think, is an important underlying support for risk assets and indeed for economic prospects more broadly.
Peter, we're going to have to leave it there. Thank you so much for your thoughts and your time this morning. Peter Oppenheimer of Goldman Sachs. By the way, those CPI figures come in 3.5 hours. Time expectation is for 0.3% month over month for both headline and core. Let's get you now some other top stories that are trending on the terminal this morning. The EU has finalized a second list of countermeasures targeting $84 billion worth of U.S. goods if it decides to retaliate against President Trump's tariff policy. That list includes Boeing aircraft, cars, and bourbon. President Trump said yesterday he is still open to more negotiations on trade after announcing a 30% levy on EU imports. Elsewhere, President Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. Trump said the levies would come in the form of, quote, secondary tariffs without giving details.
But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
And the FT reporting moments ago on that President Trump has privately encouraged Ukraine to step up its deep strikes on Russian territory. Elsewhere, in China, the economy grew more than expected in the second quarter, driven by strong exports to markets outside the U.S. The data, though, also showed weak consumer demand at home. GDP expanded 5.2% year on year. Coming up, Nvidia says it can sell its H20 chips to China again. Shares get a boost. More on that next.
The Chinese competitors have evolved and advanced greatly over the last year. One of the challenges of the changing regulations is the ability for markets to trust the Nvidia and ultimately American platforms. It's prudent, I think, for the Chinese customers to make sure that they develop their stack on Huawei, and because it's hard to rely on American technology at this point.
Nvidia CEO Jensen Huang speaking with Bloomberg a few weeks ago in May, talking about the difficulties of preventative regulation of selling their chips into China. And Nvidia shares are rising, up nearly 5% in the pre-market. Nvidia now said it expects sales of its H20 AI chips to China to resume. For more, Bloomberg tech editor Mark Bergen joins us. Mark, do we understand why the reversal from U.S. regulators?
U.S. officials have not commented yet. I mean, I think their best assumption here is that Huang and Nvidia have been arguing, China is developing AI, whether the U.S. likes it or not. And the argument from Nvidia is why not have it be built on U.S. technology where we have the control. And he said this is basically, he's called the U.S. chips policy a failure before, pretty strong language. I think that's an effective, it seems like that argument's won here, where it's saying we'll be able to control the allocation of these chips, and they're built on Nvidia and not on Huawei and Chinese technology.
What does it mean for Nvidia? As I said, the shares are rallying this morning. Mark, just how big of a win is it for the company?
Yeah, it's huge. I mean, I think that they put the number about $5 billion as this what they kind of allocated for sales in China, because they're the H20 chips that they're specially designed for the Chinese market, that they basically said they were unusable given this policy. Now you have this big boom. We're seeing this explosion after DeepSeek, large giants in China like Alibaba, as well as this new wave of startups, DeepSeek, Manus, that are really rapidly advancing these AI models that are incredibly compute intensive, that need the GPUs that only Nvidia and Huawei at this point, and AMD, a few handful of companies provide.
Though if the narrative had been from Jensen Huang, Mark, that China was advancing and that U.S. companies like Nvidia needed to be in there to arrest that advance, is it too little too late? Does China tech continue to advance and try to find replacements, even though Nvidia is back for now?
That's a good question. I mean, I think that there's a lot of lock-in. Nvidia's clearly shown that it's not just its hardware, but it has this. It's pretty advanced software that companies, once they're using the chips from Nvidia, it's really hard to switch. It's really intensive and requires a lot of effort. It might be the same with Huawei, right? Once you're locked into Huawei, why switch to Nvidia? I think clearly what we've seen demonstrated is that DeepSeek has said what little they've communicated is we wish we had a lot more Nvidia chips. And so the assumption there is that these companies that are developing AI models out of China are most likely going to buy as many GPUs as they can.
Mark, is this also just a win for Jensen Huang, the diplomat?
I would say so. I mean, I think he's up there with Tim Cook as far as tech CEOs as diplomats. This is a $4 trillion company that seems to have extremely influential political power.
All right, Mark, thank you very much. That is Bloomberg's Mark Bergen. And Nvidia lifting all boats this morning. It is an S&P 500 future session that is yet again trading at a record. The NASDAQ up 0.5%. We are seeing some dollar weakness while U.S. yields come down about 2 basis points. Okay, coming up, Wall Street earnings kick off. JPMorgan, Citi, Wells Fargo, all of the companies on deck will have what you need to watch for those results when they hit the tape. That's coming up next on your Bloomberg Brief. You are watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news and see what the major publications are running with this morning. The New York Times leads with a win for President Trump. The Supreme Court has cleared the way for the president's cuts to the Education Department, which expands his executive power. Justices lifted a federal judge's order that reinstated nearly 1,400 workers affected by mass firings. A legal challenge continues, though, to play out in the lower courts. Now, a Washington Post exclusive. ICE has declared millions of undocumented immigrants ineligible for bond hearings. The agency issued a memo instructing officers to hold undocumented immigrants for the duration of the removal proceedings. The policy applies to millions who cross the U.S.-Mexico border over the past few decades. And on the FT, catastrophe bond sales hit a record as insurers offload climate risks. Issuance of cat bonds, which transfer part of the risk for disasters to bondholders, has surged to over $18 billion so far this year. Insurers have had to pay out more than $100 billion in natural catastrophe losses every year so far this decade. And Wall Street's biggest banks kick off the earnings season with JPMorgan, Citi, and Wells set to report just this morning. Bloomberg's Charlie Wells joins us for a preview. Charlie, what you looking out for?
Danny, so it's big and there's a lot of high stakes here because the share prices of these banks have been getting close to records. That KBW Bank Index really zooming north from that downturn in the April period. And so there's a lot of pressure here, and there's some, positive expectations here, particularly on that trading side. We've seen a lot of volatility in the markets, and some right-way bets are expected at least to have gone well for a number of these banks. Citigroup on the fixed side is expected to bring in a lot of leadership on that front as far as those league tables go. And then on the equities trading side, Goldman Sachs there, also net interest income, as we're seeing the potential to bring in billions of dollars for these banks in this higher for longer rate environment. It's going to be a little bit more of a mixed picture on that investment banking front, where we've seen, some banks have strength, but this uncertainty creating more of a negative environment for that M&A activity.
Even so, Charlie, we're looking at bank share prices, many of which have been nearing records recently. How much is already baked into it?
I mean, Danny, that is really a question that's sort of dividing analysts on Wall Street right now. So in some corners, the Mike Mayos at Wells Fargo of the world, they've got a very bullish take. They see a fundamental shift, at least a generational shift in the way that banking works in the United States right now. And they see a lot of room to run for these shares that have already been approaching records, as I mentioned. But if you think about Saul Martinez at HSBC, he put out some commentary recently talking about how a lot of the uncertainty that's out there in the markets is not necessarily being priced into these shares. And we're looking at JPMorgan. We're looking at analyst ratings here right now. JPMorgan reporting later this morning. About half of analysts give that a buy rating, but others take a more cautious stance here. So, that really is speaking to the split in the analyst community, at least at this point.
What is sort of the split to the downside, Charlie? What are the expectations that could get in the way for these banking shares?
You know, they're all out there looming in the economy. No one's exactly sure what this could be, what could cut into this rally. But look, we've got these trade tensions, we've got these negotiations. If those do not go the way that analysts are expecting, that could hurt bank earnings going forward. Again, also, we have this regional divide between sort of the more regional banks and some of these Wall Street majors. And, you know, one take here is that some of these regional banks not faring quite as well in the markets, they could be exposed to the sorts of, you know, consumer issues, some of the real estate issues that would also face these larger banks, that these issues might just be masked by some of this Wall Street strength that we're seeing. So that could be hiding in plain sight. So that's a framework to view these earnings through as they report later today and throughout the week.
Yeah, and everyone also wants to know what the weather forecast is from Jamie Dimon. Most recently, he talked about markets being complacent and underappreciating some of the trade risks. We'll see whether he sounds the same on today's earnings call. Again, that is Bloomberg's Charlie Wells. Thank you so much for your reporting this morning. JPMorgan, Citi, Wells Fargo, all on deck. In the meantime, we are looking at something of a bond market rally. A lot going on in the world of finance. We're expecting both budgets for the UK and France to be unveiled. There has been a lot of tension. Governments around the world, most recently Japan, over fears of their spending. The U.S. bonds, those are down by about 2 basis points this morning at 4.4%. Meanwhile, in the world of FX, you continue to look at a weaker dollar this morning, while the euro trades at 116, sterling at 134. Coming up, we look at private credit and the expansion into retail. We're going to talk with James Clarke of Blue Owl after their announcement about 401ks and a partnership there. That's next. This is Bloomberg. It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. A win for chips. Nvidia expects to gain U.S. approval to sell a model of its AI semis to China. Fighting back, the EU finalizes another list of tariff countermeasures to target U.S. goods worth over $80 billion. And bank earnings kick off. JPMorgan, Citi, Wells Fargo, all on deck alongside CPI data this morning. So yes, it is CPI day and the unofficial start to U.S. earnings season, and we start with another record high on both the S&P and NASDAQ futures, NASDAQ being led by Nvidia this morning after the resumption of their exports of H20 chips. We also got the latest Bank of America Fund Manager survey. Risk appetite surged by the most ever in the past 3 months. Bonds, they are little changed this morning, especially on the front end after a sell-off yesterday. That starts to ease, though, with yields down about 2 basis points for the 10-year. We're at 441. Brent crude switches from losses to gains this morning after a more than 1% decline after President Trump threatened 100% sanctioned secondary tariffs on buyers of Russian minerals if a ceasefire deal with Ukraine isn't reached. Let's look at some stocks under the surface. With that is Valerie Teitel. Hey, Val.
Hey, Danny, let's start in the tech space with those NASDAQ futures hovering at record highs. It's all down to Nvidia gaining some 5.1% after Nvidia is expected to get those export licenses for their H20 chip to sell into China, seen as a very big win for the CEO, Jensen Huang, who's been a vocal critic on these export licenses. He was in the White House last week, and now he's in Beijing to maybe celebrate this win. Let's stay in this tech sector and talk about Apple making a new investment in a rare earth company. This is MP Materials, up 11.5%. This is a report from Fox News that Apple is set to invest $500 million in this company to get their access to rare earths that they produce here in the U.S. Let's stay in the tech sector. Let's move on to CoreWeave. We do have some breaking news that they have invested in some data centers. We're seeing those shares up 5.6%. But you're seeing the theme here, Danny. We are seeing these AI-related stocks invest more in AI and get a win on chip export licenses. It seems like a great day for those tech stocks.
It does. Meta similarly talking about a new data center. Val, thank you so much. Now, elsewhere, your 401k may be getting an update. Blue Owl Capital and Voya Financial have signed a pact to develop private market investment products for defined contribution retirement plans, a push that many private credit players are making as the industry balloons and grows more popular. I'm pleased to say joining us now is a man that's helping make that investment more popular. It is James Clarke, Global Head of Institutional Capital of Blue Owl, who is on a world tour in the Middle East. James, really wonderful to see you this morning. Let's start there on your world tour. You're speaking to us from Dubai. Why the Middle East? What is your ambitions? What are Blue Owl's ambitions of growth there?
Danny, great to see you. Look, the Middle East has been an area of focus for us going back a long period of time here. We've been very fortunate to acquire a number of partnerships that have been integral to our growth. That continues to expand. And why now? We have to be here 24/7 and focused. This is an area of the market to come regularly and often. It's not just when it suits us. It's to be here 24/7 and focused. So this brings me here. But just to be clear, it's not an area that I episodically showed up in at this particular point in time. It's been a long time coming, and we've been very fortunate to build those partnerships.
Just on that, because it is this period of uncertainty, James, you feel it in the daily headlines of unknowingness of where rates go, of where trade headlines go. Does that uncertainty crop up in your conversations with LPs? How are they digesting and making those decisions to allocate capital when there does seem to be this fog around the world right now?
Look, these fogs have always persisted. I mean, if you just think about growth over the last century, I mean, for example, you had progressivism in the 1920s. You were coming out of the Great War. You had World War II. You had the New Deal. That kind of like stymied things there. And obviously in the 1960s with the Great Society in Vietnam. So these conflicts are always happening. And I think what's important to our investors, which is super important to the mandate that we fulfill, is to withstand those geopolitical shocks. Remember, we're private market investors. We're making investments for the long term. We're not fixated on the near and present. We can't be agnostic towards it. We do need to think about the implications of this, but the most important thing is we're making long-term investments, long-duration investments that can withstand these cyclical bumps.
Can we talk about one form of that long-term investment, James? I know you are there speaking to institutional clients, as you are the head of institutional capital, but it is a Blue Owl that, as of yesterday, seems to be pushing more into retail with the announcement of a partnership with Voya Capital into 401ks. What's the thinking behind that? Why push more? You already have a very strong wealth presence. Why push more into very retail-oriented type exposures?
Yeah, you're right, Danny. We have been a long-term player in the wealth space. In fact, I think that was inked in our DNA from the very start, and we've developed a dominance there. Look, what you're seeing is the democratization of alternative assets. Individual investors, just like institutions, they want to see a full palette of investment options. They can't just be, I guess, sort of handicapped by being in traditional public market asset classes. Very sort of similar to your question that you mentioned before about why people continue to invest in alternatives to withstand those shocks. They want to be exposed to that too. So this has been an integral partnership for us. It's one that, in fact, we think we can take to a broader remit of individual investors. And I think that the replication of what we've seen in the alternative space will continue. It's a very exciting development for us.
One of the often hesitations from adopting private capital into these retail 401k type products are just high fees.
Yeah.
James, if fees end up coming down for retail, does that mean that we are going to enter a cycle where fees more generally for private credit, for private capital, need to and start to reduce?
Look, while fees may potentially come down, and I use the word potentially and I underscore it because remember, our investors are looking at absolute returns. They're looking for preservation of capital. They're looking for income. They're willing to sort of withstand that trade-off, if you will. But remember, there's economies of scale here for large institutional investors. So yes, while the fees, and again, I underscore the word potentially may come down, what's super important is understand that the amount of available capital in the alternative space has only increased. I can speak to that myself personally. We have a number of large institutional investors that have significantly increase their exposure to alternatives because they've looked at other asset classes and they want to identify that asymmetric risk, and they're not necessarily just fixated on capturing the beta of the market. They want exposure that can withstand those cyclical shocks. So, back to your question, fees, are always a discussion. And when we go into partnership with people, that is something that we pay a lot of attention for. But just remember the scale of these mandates to increase. We've discussed this before, but scale is our friend. To support the types of investments we want to do, we need that capital, and our partners need to have that exposure. So there's this symbiotic relationship that is integral to both us and them achieving their objectives.
As you're going around having these conversations, James, one thing that's really changed in the world is a willingness to spend on defense. We heard it from France over the weekend that they would be spending more on their defense capabilities. It's an industry that typically private credit has shied away from, but as there is more demand, would Blue Owl, is this an industry that perhaps needs to take a second look at funding things like defense companies?
Yeah, look, you're always taking a look at all the available sectors out there. What I am going to tell you is that there are, again, these areas where on-off, is particularly around macro issues, that can potentially guide investment decisions for the short term, not the long term. Look, we always keep an open posture to things, but if you think about the way we operate, that's not a lane we're in. We really want to focus away from the non-cyclical. And I would say there is a degree of embedded cyclicality in that. Who knows what administrations are going to do? Who knows who's going to be the next prime minister or president of a specific nation? The most important thing is to stick to what your remit is, what you're focused on. So if you actually look across where we traffic, as I've said before, it really is in those cyclical or non-cyclical, should I say, sectors. That's super important to us. These are long duration investments. I don't know who's going to be president in the next 4 years. It's open for conjecture. We can all debate that. But I do think that what I do know is that the businesses we'll invest in are built to last.
James, I think you'll be relieved to know that I will not drag you into that debate. I will leave that one just sitting out there.
I am so great, Danny. I'm so grateful for that. Thank you. It never ends up well. There are two things to stay away from in a conversation, and that's one of them.
All right. I don't think I'll ask you what the second one is either. I think I'll give you relief there, James. Thank you so much for joining. It is always a pleasure to speak with you. Please come join again soon. James Clarke, Blue Owl's Global Head of Institutional Capital. Okay, coming up, the EU strikes back. Boeing, cars, and bourbon are on the latest list of EU countermeasures and ongoing trade war with the U.S. We'll hear from France's Europe Affairs Minister, Benjamin Haddad. That's coming up next on Bloomberg.
The deals are already made. The letters are the deals. The deals are made. There are no deals to make. They would like to do a different kind of a deal, and we're always open to talk.
President Trump there yesterday saying that he remains open to talks, but the EU is signaling that it's open to retaliate. The bloc has finalized a list of U.S. goods worth over $80 billion to target, if it so chooses, to counter against Washington's tariffs. Among those, Boeing jets, bourbon, and U.S. autos. For more, let's bring in Bloomberg's Brendan Murray, who tracks global trade. Brendan, what did we learn about how the EU might strike back?
Well, the European Union, up until a couple of days ago, thought it was heading closer to a deal with Trump. But as he's indicated over the weekend and in his comments from yesterday, is you never really know if a deal is going to come together with him until it's actually done. So what the Europeans are doing is preparing a list of products, of U.S. products that they will target with tariffs of their own in a commensurate way as they feel like they would be hit. So the message being sent really from Brussels is that they need to show Donald Trump that they will stand up to the tariffs that he will impose on European goods come August 1st, and to see if they can still negotiate over the next 2.5 weeks some sort of deal that prevents a transatlantic trade war.
Brendan, the clock is ticking down. Thank you very much. That is Bloomberg's Brendan Murray. And let's stay on those trade tensions between the U.S. and EU. I'm pleased to say that joining us now is France's Minister for Europe Affairs, Benjamin Haddad. Minister, thank you so much for joining this morning. And look, that announcement of a 30% tariff for the EU come August 1st, it comes after just the week prior, the EU said it was close to a deal. How much does the weekend's announcements change things for negotiations between the EU and the US?
Hi, thanks for having me. Look, let's be honest. These tariff threats are unjustified and unacceptable. And we have a strong trade relationship between both sides of the Atlantic. They've underpinned our shared prosperity for the last 75 years. And Europeans, and the Commission was quite clear about this, will defend their interest with determination and resolve. We want a good trade relationship with the United States. We want a deal that de-escalates and that's mutually beneficial. The Europeans have been very clear about this in the negotiation with the administration over the last couple months. But it is clear that we have the tools and instruments to retaliate. The Commission has already announced, as you saw, countermeasures on goods that would amount to close to 100 billion euros in trade. That's based basically on the measures that we had implemented under the first Trump administration at the time. But we can go further. We can go further with instruments that the EU has developed over the last few years. I'm thinking, for example, of the anti-coercion mechanism, which would allow to broaden the scopes to services, to technological services by taxing U.S. tech companies, by bearing access to public tenders. Once again, you know, the European Union is a vast unified bloc. It's a major trading partner to the United States. We want to continue to have a good trading relationship, but we have the tools, we have the means to defend our interest, and we will do so.
Those tools, the escalation of which, Minister, should tariffs go on as 30% in August 1st, is that enough to implement the tools at which you've talked about just there?
It's pretty clear, to answer your question, that the Commission has already signaled that if we are in a situation that's asymmetric, where we have tariffs that are unjustified, that's imposed on the European economy, then there will be a response from the European Commission.
Trump, though, did insist that the recent letters are the deals. He said, quote, there are no deals to make. Is it your assumption, though, that the letter over the weekend, that it was just a negotiating tactic, that it was escalate to de-escalate, and the rate will come down by the deadline in 2.5 weeks' time?
You know, it's not my role to speculate on what the administration wants to do. We've been very clear, once again, that the Europeans want to trade with the United States. They want to come to a deal that's mutually beneficial. They want to continue the relationship that, you know, once again, has been at the center of the prosperity and the growth of both sides of the Atlantic ever since we set up a trade system that's non-discriminatory, that's based on free trade, on access, on so many of the products that we're discussing today. But once again, it is clear that the European Union will defend itself. We've actually strengthened our instruments over the last few years. I was mentioning the anti-coercion instrument. This is something that did not exist a few years ago. And then when you look at the trade pressure that the EU has been under from different sides of the world, then we've decided to have these tools to be able to react. And so the Commission now has made clear that you have these countermeasures that are being discussed that can be implemented if we don't find an agreement. And once again, you know, in these negotiations, you need to show strength, you need to show force, unity, and resolve, and this is what Europeans will have.
Are you sure that there is unity, Minister? There has been some difference in tones, for example, from President Macron and President Merz, Chancellor Merz, rather, in terms of whether the idea is to show strength or any deal is better than no deal. Is there really that unity, or are there fears of some fractures between what heads of countries are really willing to accept from the U.S.?
You know, as you may see, maybe from the Brandenburg Gate just behind me, I'm in Berlin. And we speak to our German friends on a daily basis because we have such a strong, unified agenda on this and all the rest. When you think about stepping up our defense spending and rearming Europe, when you think about investing massively into tech, into the competitiveness of the European Union, because this is also one other way to react to the pressure that we're under, is making sure that we really support our ecosystem of innovation, our entrepreneurs, our companies in this world competition. And of course, we do this with our German friends. And you know, we've been very clear with Chancellor Merz that we want to find a deal. We want to de-escalate. That's been the objective of both France and Germany, but as well. But the question is, how do we negotiate and how do we show this resolve to our U.S. counterpart? And I think the tone coming from the European Commission saying, for example, that it's ready to implement the countermeasure is very important, precisely to stress that point.
Minister, you mentioned some of the increase in defense spending, but for France, it also comes at a time when both taxes and the deficit are high. How does France cover the cost without incurring a significant expansion of the budget deficit and at the same time really increasing and expanding the defense capabilities of the country?
You know, President Macron on Sunday made a very important speech about military spending and more broadly about the threat situation that we're facing. We have the war of Russian aggression at our border against Ukraine, but more generally the threat that Russia is posing to all of our democracies. We have, of course, the US that is signaling that it wants to focus on Asia, that it wants also Europeans to step up and take more ownership for their defense. This calls on us to bear more burden for our own security and defense. Over the 2 terms of the Macron presidency, we'll have doubled the defense budget of France. We'll need to continue to do so. It's a generational effort, and we also need to continue to do it at the European level to really have a strong European defense industrial base. This needs resources, and this is why President Macron took the initiative to call for the increase of defense spending by about 3 billion euros for this year and for the year after. And you're right, this comes at the time where we also need to make responsible choices for our budget. The Prime Minister will unveil the new budget and we'll have a sequence of negotiation with the different groups in parliaments. We need to cut on public spending. We need to bring down the debt and deficit. And we also need to continue to reform our system. Over the last 8 years, the 2 terms of the Macron presidency, we reformed our system, and this is why France became the most attractive country for foreign investments in Europe. This is why we brought down unemployment to historic lows. You know, for a long time we said that we were condemned to high unemployment. We've brought it to historic lows. This is also a way to continue to bring in fiscal income. So we'll have to bring down our spending, we'll have to continue to invest and reform, and we'll have to invest in defense, because this is really about the sovereignty and security of Europeans.
Minister, we really appreciate your time this morning. Unfortunately, coming up against a commercial break, we thank you so much. French European Affairs Minister Benjamin Haddad. You're watching Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day. JPMorgan will be kicking off U.S. bank earnings before the bell, followed by Wells Fargo and Citi. CPI then at 8:30 a.m. Eastern. And President Trump expected to deliver remarks at the inaugural Pennsylvania Energy and Innovation Summit in Pittsburgh at 3:30 p.m. Some individual stocks moving this morning. Nvidia, that leading the entire market higher by 5%, said that it will be resuming its sales of H20 chips to China. Also dropping moments ago, ByteDance and Tencent are in process to apply for Nvidia chips, according to Reuters. CoreWeave up 8%, set to unveil a $1 billion investment into data infrastructure and MP Materials. Those shares up also another chunky amount, up 11.8%. A report from Fox Business of a $500 million investment from Apple. All right, that is it for your Bloomberg Brief this morning. Surveillance takes it from here on Bank and CPI Day.